So good evening, everybody. So budget is finally done. Lots of permutations, combinations, what will happen, what will not happen. But as you reflect back, no big announcements. Stability, the core theme. Increased focus as expected on several socio-economic schemes and infrastructure spending. There was a fear that would we be bold to cross the fiscal prudence to go beyond 3.5 or will we be towards 3? Fiscal deficit is towards 3.2. So clearly the rating agencies will be happy. And if you see the reaction of the stock market and the bond market, clearly this has been well received by the financial community at large. Fears, what is the big relief? No change in capital gains tax, no inheritance tax. What is the expectation missed? No deferral of POEM and GAR. GAR and POEM guidelines are there, but clearly that is something where people were expecting that to be deferred because not too much time is there for executing it. POEM is already in place, 10 months are already over. How do you comply with the guidelines which have just come last week? GAR deferral was an expectation, but that's not happened. So what's the unhappiness? We just did a poll with the corporates, and the answer was 80% of the corporates were very happy. 64% of individuals were not very happy. 64% of individuals were happy, 36% were unhappy. Clearly, people were expecting more on the corporate tax rate front, that would this 25% rate be applicable to all or only to turnover below 50 crores. As far as individuals are concerned, really people were expecting that the slabs will get higher, the rates would be more liberal, ATC would be extended, deduction for interest on housing loans would go up, so on and so forth. So individuals feel a bit let down because they were expecting more from the budget. Corporates look to be fine. But all in all, it's a very good balancing act. Fiscal prudence, there is in it something for the common man, which means impetus to growth, electoral populism, but it balances everything well and it really looks a very stable attempt. And as we go forward, there are a lot of things which are on anvil, which are about to unfold. But the biggest thing on the anvil, first I will have my question to our indirect tax leader, Sachin. Sachin, GST. And that's the heart of the indirect tax part of the budget. What do you think of GST? Will it really come on July 1? We've been watching this for a long period of time. Should we start preparing for it? What is your assumption of it?
Well, I think most of the people have expected that the finance minister would have made some announcement about the roadmap of GST in this budget. But I guess I think it is beyond his brief because today the GST is administered or controlled by GST Council, of which he is the chairman. So perhaps he may not be wanting to make an announcement overstepping the GST Council. Having said that, the indication of not having a big bang announcement or significant policy changes in indirect tax this time mean that the government is not expecting the GST to be delayed anymore. So if you look at the current situation, government has no choice but to introduce GST before 15th of September because the constitutional provisions which allows the current taxes to continue expires on 15th of September. So therefore, government has to introduce GST by 15th of September. Logically looking at this, nobody would like to introduce a GST in the middle of a month or middle of a quarter. And since the government for once is ahead of the private sector or the industry in terms of the readiness to implement GST, in terms of the draft legislations, in terms of the GST network, which is the computer network which is going to administer GST. All these are working overtime and they are on course. The rules are expected shortly. The final draft law is to be released shortly. So therefore, government is all set to introduce GST from 1st of July 2017. Maybe in the 18th February council meeting, they may spell out the date of implementation as well. And therefore, there is no reason for anybody to think that GST will be happening or will not be happening. GST will be happening. That's the reality.
Thanks, Sachin. So July 1, the first takeover, let's get prepared. Himanshu, two things which were there on the corporate tax front, which is important for everybody. Can you just summarize the real estate impetus and the digital stuff? I saw a lot of digital stuff in the whole budget. And what are the things which can be looked out for as far as real estate and digital economy is concerned?
Right, thanks Girish. So a host of measures being proposed to give a boost to the housing and the real estate sector. For example, when it comes to computation of the area of the property, the 30 meters versus 60 meters, how do you compute it? Until now, the law provided for computation based on the built up area. Now, it is provided that going forward that shall be computed based on the carpet area. So, very welcome proposal. Other than that, the period for computation of long term capital gains has been reduced from 36 months to 24 months to bring it in line with the period of holding of shares. Again, a very welcome proposal. Similarly, for any capital gain arising from property which is invested into certain bonds which shall qualify for a capital gains tax exemption, the investment in series of bonds has now been expanded. Any bond as may be notified by the government will now be permissible, provided the redemption happens after a period of 3 years. So, these are some of the important announcements as far as the housing and real estate sector are concerned. Coming to digital economy, with a view to provide boost to the digital economy and at the same time provide disincentive to the cash economy, a series of announcements to say that wherever there is any cash donation exceeding 2,000 rupees, that shall not be allowable for the purpose of deduction under section 80G. Similarly, any cash expenditure incurred exceeding rupees 10,000 will not be allowable as a deduction for computing the business income. The limit until now was 20,000, which has now been reduced to 10,000. Apart from that, for any transaction where there is a cash receipt exceeding 3 lakh rupees, it will now be subject to a severe penalty. So, these are a host of measures announced with a view to provide a boost to the digital economy and at the same time provide a disincentive to the cash economy. Girish.
Oh, thanks, and that's very useful. So, basically digital is the way forward, and clearly there is no incentive to be digital. In the sense, there is no disincentive. People were fearing that there would be a banking transaction tax or
Yes.
something which makes you pay a tax when you withdraw money, but certainly incentives are there in various forms on various cash things like 6% and so on and so forth. Coming to Naresh, you, financial sector appears to be the most important thing as far as the government, and that's what the economic survey also says. The NPA situation has to be resolved and the sector has to be given a boost. What is your quick take, Naresh, on the financial sector and the budget? Are you happy with it?
Overall, it is positive. So far as the bad debts problem is concerned, whilst the banking regulator has put in mechanisms to ensure that banks and indebted companies come out of the debt problem, I think now the proposal is to come out with resolution bill, because which in together with the insolvency and bankruptcy code will bring about a comprehensive resolution of the entire process. So this was final leg in the coffin, that we need a resolution mechanism. So it is very good to resolve the bad debt problem. The second thing is that the securities receipts, which were hitherto not tradable, the bill says that it will now be listed and traded. So you will have retail participation, and that will really help in resolving the NPA problem. The third thing, because there is a push on digital economy, cybersecurity assumes a big importance, because you're dealing with customers' money, and trust is the biggest factor for any banking transaction, any banking sector. So I think here the government has proposed that they will set up a computer redressal team, which will ensure that fraudsters are kept at bay, to ensure that the money is safe and people have confidence in the digital economy.
So clearly digital is the name, digital is the word as far as sector, as far as tax, and that's the way forward. So remonetization is there, but digital is the way forward. Coming to transfer pricing. For the first time, I saw something positive.
Yeah,
in the sense like
that's right.
Specified domestic transfer pricing reduced in scope. What is all this all about, Hasnain? I mean, how do you summarize this amendment?
Yeah, I think I can summarize this in 3 points. One is clearly the government's intention is to reduce unnecessary compliance burden. The second is to align the transfer pricing provisions to global practices. And 3, a sincere attempt to implement the recommendations of base erosion action plans, which is an initiative of G20 and OECD and many other countries. So if we see in the budget, the domestic transfer pricing provisions have been curtailed, and the government has recognized it's no point trying to bring compliances for the revenue neutral transactions in terms of section 48(2)(b). So those compliances will now go away. The introduction of secondary adjustment is in alignment with the global practice, which is also present in para 4.67 of the OECD transfer pricing guidelines. And the last one is about the thin capitalization, which emerges from the action plan 4 of the base erosion and profit shifting action plans. So net, as you rightly said, Girish, this is moving in a very positive direction. Government is trying to send very, very positive signals on transfer pricing.
Thanks, Hasnain. And that's a big thing, because with APAs now happening and this again being restricted in scope, it brings in a lot of certainty actually.
Yeah.
Coming to money issue, infrastructure, after financial sector or with financial sector, that's another arm which is a very important arm watched in the budget. How do you summarize in a couple of minutes on the budget and the financial sector?
Indeed, Girish, I mean, it is one important sector where the linkage with the economic growth is pretty strong. I think the government continued its push towards a lot of a public spend in the infrastructure sector. In fact, with all these constraints, there have been an increase by almost like 14% from what the outlay was last year. And that was very much required to ensure that there is a push because private sector is yet to pick up on an investment side. I think the other good feature has been, this is the first time we were doing the railway budget and the general budget together. So there is a lot of integrated planning, especially on the transportation side, where you're looking at a multimodal sort of a solutions. You're providing railways as an end-to-end solution provider, working with the players on a key commodities, which is a very unique sort of a feature. I think I saw very clear, let's say a demonstration of the fact with the timelines on giving access of infrastructure to the last mile, be it rural electrification targets, pretty much on the target that they committed last year, be it in terms of spending on the rural roads. And I think this, to my mind, over a medium to long term, will create a lot of a demand pull for the infrastructure services. So that has been a quite sort of a positive Greece. And obviously, I mean, the minister did talk about something on a PPPs, because we have seen a lot of projects getting stuck because of the commercial sort of a disputes. He had talked of an institutional response to that, but I think this budget, he did mention that he's going to tinker with the Arbitration Act and then provide certain provisions there to address this commercial part of a dispute. So I think overall, I mean, it has been quite positive, and we will see that impact as we sort of move along.
Thanks, Manish. Here there was one more provision which missed attention in the budget speech, but which is far-reaching in its implication. We all go in NPAs this year. And what does the MAT mean in NPAs is a big issue which we've been grappling with. The budget has a lot of changes on NPAs and MAT. Shabir, you can quickly summarize for us what does it mean to corporate MAT burden and how will it impact profitability?
Yes, thanks Girish. It was expected that this budget will introduce new minimum alternate provisions for NPAs compliant companies, because as you know, India has adopted NPAs from the financial year 16-17 mandatorily in line with IFRS for many companies. And if you ask me, this provision is about 1 year late, and essentially it should have come in last year. And therefore, this provision is going to impact the advanced tax computation that have been done for the last 2 quarters and also for the next 2 quarters that are set to come in. And essentially what these provisions try and do is they try and neutralize the items which are going to the P&L based on fair value basis, or certain profit and loss items which are not going to the P&L because of being treated as a part of retained earning, either as a part of yearly adjustment or a part of opening balance adjustment. So as you would be aware, when Ind AS accounts are prepared for the first year, that is financial year 16-17, you also have to restate the earlier financial year and create an opening adjustment. So the guidelines provide that in case of changes with respect to revaluation in property, plant and equipment, or investment in equity shares, essentially the profit will need to be adjusted based on realization, disposal or transfer. And they have provided for treatment also with respect to defined benefit plans, essentially, which means gratuity and couple of other plans that are offered to employees. And with respect to these items, these will be taken as a part of book profit adjustment as and when this differences arises, and in case of opening items they have to be adjusted to book profit equally over a period of 5 years. And essentially these provisions also try and lay down guidelines with respect to book profit adjustment on distribution of non-cash asset to the shareholders. Essentially what happens in a case like demerger, in case of demerged company, there is a revaluation of assets that have been demerged and it is treated as a deemed dividend distribution to the shareholders. Similarly, the resulting company accounts for it on a fair value basis. The new provisions actually neutralize this accounting impact and ask you to compute the book profit on historical cost basis. So essentially what it tries to do, what ICDS tries to do for the normal tax computation, that means it tries to have the computation of income in line with the provisions that were there in the Companies Act 1956 and the old accounting standard. So what ICDS achieves in the normal tax computation, this new provisions aim to achieve for MAT under the new Ind AS scenario. Now keeping in mind this change of computation of MAT, it is assumed by the government that the MAT liability is likely to go up, because of which what they have done is they have allowed the MAT credit to be carried forward for an extended period of 15 years as compared to the current period of 10 years. There is also one small change which has been made to the foreign tax credit aspect of MAT credit. So if you have paid a foreign tax in any foreign jurisdiction which is available as a credit against the minimum alternate tax liability, then the MAT credit carry forward will be after the foreign tax credit adjustment. That means the foreign tax credit aspect of the MAT credit will not be allowed to be carried forward. So this is the change. If I can sum up very quickly with respect to Ind AS, essentially it neutralizes the fair value basis of accounting and the retained earning and the equity kind of concept which the Ind AS bring in, and it relates or allows the book profit to be computed on a historical cost basis as has been done under the current provisions of section 105 JV. Thanks.
Thanks, Shabir. So that's it for our end at KPMG. Thanks for being with us, and we'll come with you with more updates in the next 48 hours on the interpretation of finer prints as we go through it. Thank you very much.